now, everybody. Quiet, listen to me. We're going to start a show. Now, some of you people have been with me before. You know it's going to be a tough grind. You're going to dance until your feet fall off. You're not able to stand up any longer. But we're going to have a show.
Welcome to today's episode of the Pink Door podcast. Today we'll be discussing home buying in the 2026 landscape.
It's great to be here. And honestly, if there was ever a time to have this specific conversation, it is right now.
I feel like we need to take a deep breath before we even start because, well, let's set the scene for everyone listening, right? The context is everything. It is late February 2026. And if you were trying to buy a house in 2024 or 2025, you probably have some genuine emotional scars.
Absolutely.
I mean, I had a friend who put in 7 offers, went $50,000 over asking on a place that smelled like wet dog, and still lost. It was just a war zone.
It really was. It was a seller's market on steroids. But the data we're looking at today suggests the wind has finally shifted. We aren't in that frenzy anymore.
Thank goodness.
Yeah, the market has moved from that intense, desperate seller's advantage to something that looks a lot more balanced.
Balanced is a beautiful word. But does balanced mean easy? Because that's the whole mission of this deep dive. We have a massive stack of research here. Mortgage outlooks, credit bureau guidelines, lender cheat sheets.
The fun stuff.
Right, the fun stuff. And we want to decode this ultimate guide to buying a home in 2026. We want to strip away the jargon. We're talking about mortgage rates, credit scores, contracts, the stuff that usually makes your eyes glaze over.
Right.
And we want to reveal how you can actually save tens of thousands of dollars and avoid that emotional burnout.
And we really need to ground this in hard data immediately.
Yeah.
Because people have, a lot of feelings about real estate, but the numbers tell the actual story.
Okay, so lay the snapshot on us. What are we actually looking at right now?
So as of this week, the median existing home price is sitting at $396,800. And if we look at the cost of borrowing money, the 30-year fixed mortgage rates are hovering right around 6.1%.
Which, just for context, that sounds high if you're stuck thinking about 2021, but it's actually a 3-year low.
Exactly.
Yeah.
And that is the mental hurdle you have to clear. We are not going back to 3%. Forecasts from Fannie Mae and the Mortgage Bankers Association are predicting rates will stay pretty flat.
Like where?
Likely in that 6.2 to 6.4% range for the rest of the year. But here's the silver lining. Inventory is rising. There are actually houses to buy.
Finally.
Yeah. And interestingly, half of the top 50 metro areas have actually seen price declines.
So it's not cheap, but it's accessible.
Right.
But let's be real, accessible is a relative term. I want to talk about the barriers to entry because there are myths out there that stop you before you even open up Zillow on your phone. The biggest one is the down payment.
The 20% rule.
Right. There's this persistent belief that if you don't have 20% of the purchase price sitting in a briefcase, you aren't a serious buyer. On a $400,000 house, that's $80,000.
Which is huge.
For most people, that takes a decade to save. Is that still the reality?
It is a myth we need to debunk right now. Look, 20% is the gold standard if you want to avoid private mortgage insurance or PMI, sure. But it is absolutely not a requirement to get the keys to the house. If we look at 2026 lending standards, the reality is much, much more flexible.
Okay, but isn't there a catch? If I put less down, don't I get penalized?
Well, let's look at the options first. For an FHA loan, which is government-backed and huge for first-time buyers, you only need 3.5% down.
Wow.
And for a conventional loan, which is the standard loan, you can get in for as low as 3% through programs like Fannie Mae Home Ready. So instead of $80,000, you need
About $12,000.
About $12,000, exactly.
That changes the timeline from someday to right now. But go back to the catch, the PMI.
Yeah.
Isn't that just throwing money away every month?
Think of PMI as the cost of access. Yes, you pay a monthly premium, maybe $100 to $200, depending on your credit, because the bank is taking on more risk. But you have to weigh that against the cost of waiting.
What do you mean by the cost of waiting?
If you wait 5 years to save that full 20%, and home prices rise 3 or 4% every single year, the house itself becomes more expensive than the PMI would have been. You're often stepping over dollars to pick up pennies by waiting.
That is a really important reframe. It's the price of admission to stop renting. Plus, for our veterans, VA loans are 0% down. USDA loans in rural areas are 0% down.
Exactly. The barrier isn't usually the cash pile. Usually the real barrier is the credit score.
The other monster in the closet.
Let's talk about the reality of credit in 2026, because I think people assume you need a perfect 850 or the bank just slams the door in your face. Not at all. The floor is actually lower than you think. For that conventional loan we talked about, the minimum is usually 620. For FHA, it's even more lenient. You can qualify for that 3.5% down payment with a score as low as 580.
Wait, really? 580?
Yes. And here's where it gets fascinating. If you have a score between 500 and 579, you can still qualify for an FHA loan, but the down payment requirement bumps up to 10%.
So homeownership isn't technically off the table, even with a score in the low 500s. But, and I feel like there is a big but, coming here, just because you can get a loan doesn't mean it costs the same.
Precisely. This is what we call the cost of credit, and the math is brutal. We ran the numbers on a $400,000 loan. The difference in the interest rate between a buyer with a 740 score, which is great, and a buyer with a 640 score, which is acceptable, is significant.
Oh, significant.
It translates to about $250 a month extra for the lower score.
$250 a month? That's a car payment. That's a really nice dinner out.
Over 30 years, that is over $90,000. You are paying $90,000 more for the exact same house just because of the three-digit number on your credit report.
That is nauseating. 90 grand just gone. Okay, so if you're listening to this and checking your credit app in a panic right now, how do you stop the bleeding? What are the actual tactical steps to fix this quickly?
First, stop guessing. You need the official reports. Go to annualcreditreport.com. The FTC mandates you get free reports, and in 2026, you get about 6 free reports a year. You are looking for errors.
Is it really that common to have errors? I feel like banks are pretty good at math.
You would be shocked.
Yeah.
A wrong address, a closed account that's listed as open, a medical bill you paid that is still marked as in collections.
Oh, wow.
Dispute those immediately. It is the fastest way to artificially bump your score because the Bureau legally has to investigate it.
Okay, so I dispute the errors. What about my actual spending habits?
Utilization is king. That's the percentage of your credit limit you're currently using. If you have a $10,000 limit on your credit card and your balance is $4,000, you're at 40% utilization. That hurts you.
So where does it need to be?
You need to get that under 30%. But honestly, if you're buying a house soon, get it under 10%.
Pay it down before you apply. Makes sense.
And for listeners who might have had serious financial trouble, like a bankruptcy or foreclosure, there is a waiting period, but it's not a life sentence. Chapter 7 bankruptcy is usually a 2 to 4 year wait. Foreclosure is 3 to 7 years. You can come back from it.
Okay, so we've scraped together the down payment, we've polished the credit score, now we need to actually talk to a lender. And this is where the vocabulary gets tricky in our research. Pre-qualified versus pre-approved. They sound exactly the same to me, are they?
Huge difference. In this market, pre-qualification is basically a napkin sketch. It's a guess based on what you tell a lender over the phone.
So it means nothing.
It holds zero weight when you make an offer. Pre-approval, on the other hand, is a weapon. The lender has verified your W-2s, your bank statements, your credit. You literally cannot step foot in a house with a serious agent without a pre-approval letter.
It's your ticket to ride. Now, once you have that ticket, do you just take the very first offer you get? Because our deep dive highlighted a stat that blew my mind regarding shopping the rate.
This is the single biggest financial mistake buyers make. They spend months shopping for the house, but maybe 30 minutes shopping for the mortgage. A recent analysis showed that shopping with 3 or more lenders can save a buyer up to $44,000 over the life of the loan.
$44,000 just for making 2 extra phone calls.
Yes, because lenders have different appetites for risk. One bank might be overloaded with loans and quote you 6.4%. Another bank might be hungry for business right now and quote you 6.1%. That tiny spread compounds massively over 30 years.
But wait, and this is the part that scares people. Doesn't having 3 different banks run my credit tank my score?
No, and that is the misconception that costs people so much money. The credit bureaus aren't stupid. If you get all those estimates within a 14-day window, the scoring models treat it as one single hard inquiry.
Oh, I didn't know that.
Yeah, they know you're rate shopping. It's a dedicated window for you to find the best deal without penalizing you.
So block out a week, make the calls, and save 40 grand. That's a no-brainer. Now let's talk about another term I see in the fine print. Discount points. This sounds like a loyalty program, but it actually costs you money up front.
Think of discount points as prepaid interest. You pay a fee up front at closing, and 1 point equals 1% of the loan amount. In exchange, the lender lowers your interest rate by about 0.25% permanently.
Okay, let's do the math on that. On a $400,000 loan, 1 point is $4,000. I pay that cash today and my rate drops from, say, 6.25% to 6%. Is it worth it?
It is entirely a math equation based on time. That 0.25% drop saves you maybe $60 or $70 a month. So if you pay $4,000 to save $70 a month, it will take you roughly 57 months, almost 5 years, just to break even.
So if I move in 3 years, I literally lit that money on fire.
Exactly. Discount points are for the forever home. If you think you might move in 5 years, or if you think rates will drop and you'll refinance anyway, do not pay for points. It's a waste.
That is a crucial distinction. Now, speaking of rates, there is a specific opportunity in 2026 that seems to be popping up constantly with new construction. Builders are sitting on inventory, right?
Yes, and builders hate sitting on inventory. It costs them money every single day. But they also hate lowering the asking price because it upsets all the neighbors who already bought in that subdivision.
Right. Nobody wants their home value to drop before they even unpack.
Exactly. So instead, they offer rate buydowns. The most common one we are seeing is the 2-1 buydown.
Explain how that works. Who is actually paying for it?
The builder pays it. It's a subsidy. Basically, they prepay part of your interest for the first 2 years. Your rate is 2% lower in year 1 and 1% lower in year 2. So if the market rate is 6.5%, you pay 4.5% the first year.
That is a massive difference in the monthly payment.
Huge. It eases you into the mortgage.
Mm.
But you have to be careful. You need to make absolutely sure you can afford the full payment in year 3 when it goes back to the regular rate. But as a tool to save cash in those really expensive first years of homeownership, it's fantastic.
Okay, let's pivot to the stuff that keeps people up at night in cold sweats. The gotchas. We've talked about the down payment, but that is not the only check you write on closing day. What else is draining my bank account?
This is where the cash to close shock happens. First, you have closing costs. These are the lender fees, title insurance, government recording fees. It's typically 2 to 5% of the loan amount.
2 to 5%.
Right. So on that $400,000 home, you need to bring another $8,000 to $20,000 to the closing table.
That's a lot of cash, and that's on top of the down payment.
On top of it, and the lender also wants to see reserves.
Wait, they want to see money I'm not spending.
Correct. They want to see that after you pay the down payment and the closing costs, you still have 2 to 3 months of mortgage payments just sitting left in the bank.
Why?
They need to know that if your water heater explodes the day you move in, you won't default on a loan. It's a safety net, but it means you can't drain your account to zero just to get the keys.
Now, here is a risk that sounds like an absolute nightmare scenario. The appraisal gap. I've heard horror stories about this. Walk us through it.
This is the danger of bidding wars. Let's say you fall in love with a house listed at $400,000. You really want it, so you offer $420,000. The seller accepts. You're thrilled.
Pop the champagne.
Right. But then the bank sends their appraiser, and the appraiser says, no, looking at the data, this house is only worth $400,000.
So the bank just gives me the 400.
The bank only lends on the appraised value. So now there is a $20,000 gap between what you offered and what the bank will actually cover.
And I have to bridge that.
You have to pay that $20,000 in cash right then and there, or you have to somehow convince the seller to lower the price back to $400,000. If you can't do either and you didn't have an appraisal contingency in your contract,
You lose the house.
you lose the house and you could lose your earnest money deposit.
That is terrifying. Which leads me to rent to own. I see signs for this sometimes nailed to telephone poles. It's marketed to people who can't quite get that mortgage yet. Is this a clever hack or is it a predatory trap?
It is nuanced, but it often leans toward a trap if you aren't very careful. The mechanics are you rent a house, but you pay an upfront option fee, usually 1 to 5% of the price, for the right to buy it later. You also pay a premium on your monthly rent that goes toward the purchase.
It sounds okay in theory. I'm building equity while I rent.
In theory, yes. But the contract is incredibly strict. If you are late on rent even once, or if you decide not to buy the house at the end of the term, you usually forfeit that entire option fee and all the extra rent credits. You walk away with nothing.
So you could lose thousands of dollars.
Easily. The verdict from the research is this. Rent-to-own makes sense only if you truly cannot get a mortgage, like maybe you can't even get that FHA loan yet, and you strictly need 2 to 3 years to fix your credit while living in the house.
But otherwise.
Financially, it is almost always more expensive than just getting a standard mortgage.
So if you can qualify for the FHA loan, just do that.
100%. Just do that.
All right, let's talk strategy. We've got the money. We know the risks. When do we strike? Is there a best time to buy in 2026?
If you want to bargain, you want to be shopping in Q1, the winter.
Because nobody wants to move their couch in the snow.
Exactly. There is way less competition. Families don't want to pull kids out of school in the middle of the year. The weather is bad. So the sellers who are listing in February or March are usually highly motivated, and the other buyers are staying home. It's the absolute sweet spot for negotiation.
And what about the houses that have just been sitting there? The stale listings.
That is your gold mine.
Yeah.
Look for homes that have been on the market for 30, 45, 60 days. In 2026, those sellers are getting very nervous. They're wondering what is wrong with their house.
And that's where you can ask for things.
Right. But here is a pro tip. Instead of asking for a $10,000 price drop, ask for $10,000 in seller concession.
What's the difference? Why does the seller care?
If the seller lowers the price, it hurts the comps for the neighborhood, meaning their neighbors get mad because it lowers their property values. But if they keep the price at $400,000, but give you $10,000 at closing to cover your fees, they get to say they sold for full asking price, and you get to keep $10,000 of your own cash in your pocket. It's a win-win.
That is a brilliant negotiation tactic. Now, let's talk about contingencies. In 2025, people were waiving everything, inspection, appraisal, their firstborn child, just to get an offer accepted. Please tell me we are done with that.
We are entirely done with that. In this balanced market, you should never waive the big three. First, the inspection. You need to know if the wiring is about to catch fire or the roof is leaking. That's non-negotiable.
You really don't want to buy a money pit.
Second is financing. This protects you if you lose your job a week before closing and the loan falls through. You get your deposit back.
Very important.
And third is the appraisal, which protects you from that nightmare gap we talked about earlier. These are your safety valves. Use them.
Okay, so we make the offer, it's accepted, we have our contingencies in place. How long until I'm actually moving in?
It's a process, usually 30 to 60 days from the acceptance to closing. The bank needs time for underwriting. The title company needs to check for liens on the property.
And what's the final boss battle of this whole process?
The closing disclosure. You get this document exactly 3 days before you sign the papers. You need to sit down and check it line by line against the original estimate the lender gave you at the start.
Looking for what?
If the fees have magically jumped up, or if there's a junk fee you don't recognize, you ask about it immediately. Do not just blindly sign it.
So, to summarize our deep dive today, the 2026 market is friendly, but it's complex. You can get in with a lower down payment, but you need to watch your credit score like a hawk. You need to shop your rate to save that $44,000, and you need to have cash reserves for the hidden closing costs.
That's it in a nutshell. It requires financial preparation and a bit of emotional resilience, but it is very doable.
I want to end on a philosophical note here. We hear this all the time. Renting is throwing money away.
Right.
But with rates at 6%, buying is obviously expensive too. Is renting really that bad?
Renting isn't bad. You get a roof over your head, and maintenance isn't your problem.
Yeah.
But here is the provocative thought I want to leave you with: inflation. Rents are predicted to rise about 2.3% in 2026 alone, and they will likely keep rising every single year after that. When you buy with a fixed-rate mortgage, you are locking in your biggest monthly expense for 30 years.
So your housing cost is just frozen in time.
Exactly. In 10 years, your mortgage payment will look incredibly cheap compared to whatever rent prices are doing. You are buying stability. You are buying control over your future cost of living. That is an intangible asset that goes way beyond just building equity.
That is a really powerful way to look at it. You're basically hedging against the future. If you have any questions about this episode, or if you are thinking about buying or selling a house anywhere on Boston's South Shore from Southie to Sagamore, give Jim Aldred a call. He would love to speak with you. Jim believes that people in transition often feel anxious about buying or selling a home, and he provides them with the guidance and security to help your family move on smoothly. Thanks for listening, and catch you on the next episode of the Pink Door Podcast.